Welcome back to the Money Wisdom Podcast, powered by Johnson Bernetti. My name is Jake Dozer, joined as always by Nick Colantuno. We are financial advisors on the team at Johnson Bernetti in Connecticut and Massachusetts, and certified financial planners as well. And we're happy to have the conversation today. Our conversation today is all about donor-advised funds. In fact, we have a question in front of us by one of our listeners, and they said this. They said, how does a donor-advised fund work? I've seen them talked about a lot recently, but I'm unclear on how they're helpful. So a donor-advised fund. So let's do this. Because we're talking about jargon, which our industry is full of, let's first define donor-advised funds, and then we can talk about how they relate to a person's retirement strategy in reducing taxes. Hint, that's kind of the direction we're headed. Nick, set the table for us. What is a donor-advised fund, and how do we interpret this?
Well, look, the simplest way to think about a donor-advised fund, it is a fund that is set up for you to be able to give money in a charitable way. Now, a donor-advised fund gives you, as the grantor, as the gifter, a lot more flexibility and control over that money, not only as it's there working for you, not only in the year in which you make the contribution, which you get the charitable deduction for, but also in future years when it comes to where you're actually gifting that money. So again, donor advised funds are in the news a lot because of that flexibility and control. So if you are charitably inclined, you want to make a gift to charity, but you haven't yet specified the charity. You just know that, oh my God, Jake, the end of the year is coming in 2 weeks and I need to get this contribution on the books for this tax year. You can put it in a donor advised fund and then worry about exactly where that money is going to go later on in the future.
That's spot on, and functionally, let's talk about when would a donor advised fund and leveraging that, when would that be of benefit to someone? Well, I'm thinking of a business owner who just sold a business and just encouraged a large taxable event. Or maybe you just sold a bunch of stock, or you just came into a windfall that is a taxable event. And you need to say, let me offset some of these taxes by doing a large charitable contribution. Well, that would be a scenario in which utilizing a donor advised fund would be of benefit. So instead of giving to 10 charities directly, you're putting a lump sum of money into a fund that locks in the charitable write-off that year. And now down the road, whether it be the following year, the same year, or over the next 10 years, you're able to slowly dole money out of the donor advised fund to charities of your choice. Well, functionally, I'm thinking of beyond the reason you'd use a donor advised fund, two common scenarios in how you would use them. One scenario might be, hey, I have a highly appreciated stock. Maybe I work for a company that gives me stock. Maybe I get an employee stock purchase plan. Maybe I have RSUs, restricted stock units, and I just came into money. And I've got this stock that I bought for a low amount, and now it's worth a ton more. If I sell it, I'm going to pay taxes on that huge gain. Well, here's a common thing that you could do. You could give that stock to a donor advised fund. And guess what? You were able to just put that stock in a donor advised fund, get a write-off. You didn't pay the taxes on the sale, so you didn't pay the taxes on the gain. And a registered 501c3 can sell that stock and pay zero in taxes. So instead of the government getting a portion of that gain, the charity got 100% of it. That would be a more effective use of your money and a more effective use for the charity as well, so that Uncle Sam is cut out of the middleman. Another example might be somebody who doesn't necessarily have a large windfall in a given year, but rather says, you know what, I'm giving to my church, for instance, every month or every year, or I'm giving to a charity. Maybe it could be the ASPCA, like some animal charity, whatever it may be. But I'm giving, and my standard deduction is so high that I don't get to write off my taxes. Here's an idea. Maybe you group 3 to 5 years of charitable giving together in 1 year. So instead of giving $10,000 a year, you give $50,000 in one time. Well, now that's above my standard deduction. I get to itemize this year. And then I can dole the money out of the donor advised fund each year. So the charity doesn't even really notice a difference. By the way, notice with the donor advised fund, since you get it put it in a donor advised fund, you can invest it in there. So if the money doubles, that gain is also net taxable. And now more money is flowing to that charity of choice. Maybe it's your church, maybe something else. So those are some functional things. Now, I think that we'd be remiss when talking about donor advised fund to not talk about sort of a cousin of the donor advised fund, which is ways to charitably give in retirement without losing tax benefits. And I'm thinking of a common strategy that people look to deploy that there's a lot of misinformation around. Nick, can you give us some clarity around, there's another jargon term, QCDs, qualified charitable distributions. How are they alike donor advised funds? How can people leverage them, et cetera?
Everybody always asks, Nick, how do I take money out of my retirement accounts and pay zero taxes on it? The only way to do that is you have to give it to charity. And, believe me, our kids are not charity. It might feel like it at some points, but a charitable contribution or a qualified charitable deduction from your IRA. Now, keep in mind, in order to do this, you have to be at least 70 and a half. Mm-hmm. Now, what this allows you to do is actually take up to $100,000 a year out of your IRA or out of a combination of all your tax deferred accounts. And if you give that money directly to charity, one thing it will do is satisfy any RMDs that you have to take, any required minimum distributions. 2, it will not result in any taxable income to you. And 3, it'll give that money to the organizations that you care about where they pay zero tax on it. So you talk about having a meaningful impact. I'm always encouraging people, if you're gifting each and every year anyway, the most efficient place to gift from, if you're eligible to do it, which is the age requirement, gift it from your IRAs, gift it from those tax deferred accounts where if you were to take that money out, pay a bunch of taxes on it, and then turn around and gift it from your checking account, well, you could have eliminated all those taxes in the first place. So those qualified charitable deductions, the QCDs, being able to move up to $100,000 a year in taxable income out of your IRAs, give it directly to charity, you eliminate all the taxes, you satisfy your RMD, and really in doing so, you're able to maximize the impact that you have.
Are you ready to retire with confidence? Join us for our retirement planning workshop and learn strategies to maximize Social Security, healthcare, income planning, taxation, and more. Text WORKSHOP to 800-757-0436 to reserve your spot, or click the link in this week's show for more details on how to register.
That's huge. And so effectively, just to kind of boil that down to the nuts and bolts of it, is instead of you taking a withdrawal from the IRA, paying the taxes, and then writing a check to your church or whatever, what you're doing is you're telling your financial advisor or your financial custodian, send that money to the charity directly. Don't give me the money first. And by doing so, you're not paying any income tax. I've probably, with my clients, done a little over $100,000 in QCDs, qualified charitable distributions, this year. And it's as easy as a couple forms. And it's something that everyone should be considering, especially if you have done a good job saving, especially if you're in the years where you recognize, ooh, I have enough money. I'm going to be okay. Well, then start maximizing the legacy that you can leave behind, not only to your loved ones, but to a charity, especially for those folks who have a single year event, or they want to group their charitable contributions together to both provide to the charity, but also make sure that they're not losing it because it's not counted for them because they're taking a standard deduction. There's so many scenarios where gifting to charity through these two avenues and others can be of benefit. And if you're saying to me, I'm not having that conversation with my financial professional or accountant, let me just fill you in. This is part of a robust financial planning process. If these types of conversations aren't being happening at least every few years, let alone every year, you're missing out on a component of your financial plan to pay less taxes and make your money leave a legacy beyond you. I hope today's content has been helpful. Again, my name is Jake Dozer, joined as always by Nick Colantuno, certified financial planners and financial advisors on the team at Johnson Bernetti. If this was helpful, be sure to give this video a like, share it so someone else can benefit, and subscribe so we can see you next time.
Investment advisory services offered through JB Capital LLC. Insurance products offered through JN Financial LLC.